CEO of Tozy Capital, as well as Parker, who is the CEO for FTW Investments, on our new investment offering that we're really excited about. We have been partnering with FTW closely for a while now. This is now, I believe, our 5th deal together. So really great relationship. They offer a lot of really great advantages of boots on the ground, great experience in the area. So looking forward to another investment with them. So I'll hand off to Ang, but I'll also be watching chat. So feel free to shoot any questions there and I'll kind of be moderating.
Thanks, Brett. I'm here with Parker and I'll drive this deck and I'll ask Parker to inject his expertise where it's needed, which is often. So we've invited everybody to our webinar, Independence Towers, but we have a surprise announcement. It's no longer going to be called Independence Towers. And I wish I had a keynote. This would like be a stomp or some kind of confetti explosion, but Google Slides does not have that kind of animation. It is now called Stoneybrook Towers because we have recently just got under contract on Stoneybrook Apartments, which is a apartment building that we've been circling and trying to acquire for quite a while. Parker can go into more detail on that, right next to Independence Towers. Plus we have Independence 3 as another asset, so we didn't want to confuse ourselves. Too much independence. So this is going to be a relatively short web presentation. We don't want to bore you guys with all the details, but if you guys have any additional, more detailed question, me and Parker and Logan and the rest of the Tozy and FW team are always happy to talk about it. So and especially afterwards as well. So we'll go through confidentiality, investment overview, location, highlights, terms, forecast analysis, and property information. So just an FYI, remember, you guys are invited because we all know all of you guys, and we want to make sure that this is you understand this is a private offering. So please let us know before you share. We do love sharing, but just let us know. Thanks. So the investment is Tozy Capital and FW is really excited to present this diversified investment offering with the acquisition of 2 separate properties, Independence Towers and Stoneybrook Apartments. With 93% occupancy and below market rents, this 171 unit portfolio offers a blended strategy of value add while simultaneously offering a strong cash flow opportunity with significant tax advantages. Synergies like cost savings and shared amenities make Stoneybrook Towers a strategic addition to Tozy Capital and FW Investments' existing portfolio of 426 units in the rapidly growing city of Independence. We just closed on 3 other apartment buildings in the last 2 months. So this will take us to well above almost 600 units. And I'll kick it to Parker to explain why do we believe these 2 are such great assets together.
Awesome, thanks, Ang, and pleasure to be here with everyone this evening. So what we have here is the Independence Towers and the Stoneybrook Apartments, and these are 2 assets that we really believe were better together than separate. We liked both individually, but these assets here in Independence are, obviously they're adjacent to each other, but one of the things that we really love about having them together is that we have the ability to share some amenity spaces. We get to share things like, obviously we could share parking if that was a concern, but it's not, but things like the pool that we have at the Stoneybrook Apartments and the fitness center that we have at Independence Towers. Part of this plan is to take the office at Stoneybrook and convert it back to a unit. So that gives us another unit to lease, since we'll have on-site management in the Independence Tower. So we love both of these properties and like them even more together.
Yeah, so can you talk about the investment highlights as well?
Absolutely. So one of the things that we talk to people a lot about and that we get a lot of questions about is COVID pricing. We are getting these at a discount to market price and frankly to the offer price. And so we are very satisfied with where we're coming in on our basis here. The blended strategy that you'd mentioned before is that we really have kind of a core plus strategy on Independence Tower, really good current day cash flow. And we also have a value add opportunity over at Stoneybrook where we're able to turn over some units and push some rents. And so that helps kind of get a blended return between the value add and core plus strategy and really get a high cash flow pair of assets with upside. Shared amenities I spoke to here a minute ago, but we'll share things like pool and fitness center between the two. One thing that people ask about too is, what does the new development pipeline look like? Well, there are some new developments happening in Independence. They're mostly south towards kind of the Lee Summit corridor. So this area, there has not been more than 20 new units developed since 2003. And so we don't see a whole lot of pressure from oversupply. Market familiarity, obviously we're from Kansas City, born and raised. My grandparents owned grocery stores since the 1940s, 3 blocks down the street. So this is an area that I grew up in, playing in the produce aisle. And then, of course, cost synergies, having both these properties as well means we get to share management costs and kind of blend costs across both properties, having a shared office, et cetera. So it'll reduce our overhead and managerial expenses between the two assets.
So I don't live in Kansas City. I'm in California, like some of you guys or most of you guys. And I just flew back from Kansas City. It seems like Parker knows everybody there and his family lives everywhere. Everywhere we buy is basically where his parents or grandparents or cousin lived. But I love the fact that he has such an intimate knowledge of the location. I would not invest in California for cash flow, but Kansas City is one of my favorite places to invest. So it's great to have a partner like Parker and FCW to help steer us to the right locations. Parker, you want to go over the investment terms?
Absolutely. So for this property or this portfolio, we have a preferred return of 8 or 9%, depending on the investment amount there. 8% for investments under $200,000, 9% for investments over $200,000. For this, we're targeting a 12% average cash on cash yield over the hold period, an average annual return of 20%, which the AAR is an estimate. It's basically your cash flow minus your return of capital divided by the number of years. Just if anybody wants to do the math, but a 20% average annual return. We're going to hold these assets for 10 years. We expect that we will refinance Stoneybrook within the 4th or 5th year. We have long-term financing already in place on Independence Towers, and we're targeting an equity multiple of 2.8 times over the 10-year hold. One of the things that we mentioned is a big benefit on projects like this is that things like cost segregations, which we will do, push a lot of the paper depreciation through to investors and provide substantial tax benefits.
And one of the things we're targeting, we will do is we will be closing the investment and purchasing these before the end of the year, which I know for a lot of investors, we're looking for that really nice bonus depreciation for the 2020 tax season. So this will get you there. We'll do the cost seg right after we purchase it. That will count for the 2020 tax season. And when you get your K1 in April or late March of 2021, you receive a significant bonus depreciation in that K1. Parker, can you tell us why we're doing a 10-year hold when typically we do 5 years?
Absolutely. So the financing that we are able to walk into on Independence Towers is really good financing, and we're assuming a loan that has a long time period on it. And so what we'll do is we'll hold that for a longer period. And I think one of the pieces that we love about this asset as well is that on the towers, we're not chasing cash flow, we're not chasing appreciation. This is present day cash on cash, and so we see this as a long-term cash flow generating asset that will appreciate with us, but that it's going to continue to produce high cash flow.
Yeah, I know a lot of people say they do conservative underwriting. I truly believe we do. We own a lot of properties, Independence. We're buying as much of the city as possible. We personally know the mayor. She's a great person. She's a very big advocate for development in Independence. And so we can see a very bright road ahead in this submarket of Kansas City. So we just want to highlight the cash flow here. Typically, what we try to do is provide the 12% cash and cash returns. So it will be 9, 19, 30, 42. But year 5, you will see a significant return of capital back as part of that refinance. And then you just continue to cash flow and ultimately be 2.8, around 2.8x return on your capital. And this does not include your 100K return, which you will receive at year 10. Parker, can you walk us through how this compares independence? Yes.
Sorry, just real quick. We had a question about the taxes. I know you just discussed taxes, so I just want to double check. Was that question answered?
Yeah. So we typically ask hope questions at the end, but I'll explain the taxes because this is something that I'm a huge advocate for. Real estate is one of the best ways to invest and to mitigate your taxes. So part of the bonus depreciation that is enabled through the Jobs Act of 2017, you can do a cost segregation, and the cost segregation typically will yield 20 to 25% of the non-land value as a depreciation. So that takes anything 15, 10, 5 year and accelerate that. And so what I really look for when we buy things is both leverage. So higher leverage gets you more share of that depreciation, and 2, low land value. So if you buy in California, you're typically seeing a much higher percentage of your purchase price as land value. Buying in Kansas City, you can, and Independence, you could see something as low as 5% or even lower. So you're getting a lot of your investments worth in terms of depreciation as a share. So in some cases, we've seen it where it's up to 80 to 90%. So we're taking a very conservative line here at 65%. So you invested $100,000, you get $65,000 in a paper depreciation loss in your 2020 K1. That is a very typical thing that we've seen, and we don't expect anything different for these investments. And if you guys can't use that depreciation, you can then leverage that and capture that for future cash flow as well. But we'll continue to the presentation. We'll try to answer questions as we go along too. So Parker, can you talk through how Independence Tower or Stoneybrook Towers compares to the other apartments or buildings nearby?
So we always shoot to be, conservative in our underwriting. And so one of the things is that, we see here, so there's 2 pieces to this, right? So if you check the rent comparables, we have Independence Towers and Stoneybrook East Apartments as the first 2 here, and compared to the average rent of the comparable set of 708, we are, anywhere from $107 or about $75 under market, $76 under market. So there's an immediate ability to go in and push rents. And these are properties that are already in comparable quality to Stoneybrook East and Independence Towers. And so that's a kind of value that we could capture without, frankly, having to do improvements. But we will be doing improvements at Stoneybrook. We'll be doing some very, very light stuff as we turn units with Independence Towers. Additionally, we also like to underwrite that we are not going to hit market rents. And so our underwriting is conservative. It still pegs us being below market. And we like to underwrite below market rents and show kind of upside over and above that. We'd hope to achieve, more aggressive rents, but we certainly like to underwrite it as if we are not going to hit market rent.
Yeah, and one of the rent comparables is one of our apartments. So we're very familiar with the Independence market. We own Meadowbrook. We just closed on that last month. One thing that people definitely are concerned with is the impact of COVID on rent collections. As we've gone through the summer and gone through more hot spots, that's definitely a concern for a lot of folks. But we just want to present real data here, and this is a survey conducted by the National Multifamily National Council of 11.4 million units across the country. And what they've seen is only a 1 to 2 point dip in percentage of rent payments made on a year-over-year basis, even past the July, August, September, October period where that extension of that stimulus bill and additional unemployment support ended. One thing that I want to note also is not all markets are the same. While you see markets like San Francisco have decreases in rents, some significant percentages, you also see Kansas City being one of the top 5 rent growth markets in the city and the nation in the past month or two. So it's definitely all still very local. And we fundamentally believe in the long-term prospects of Kansas City. Parker, what are you seeing in some of your other properties and properties we own in Independence?
Yeah, so across our portfolio, our trend line is very much in line with this. We're seeing about 95% collections. Previously we would actually see as much as 98, 99% collections, but we're seeing 95% up kind of across properties, and that's average sort of across the whole portfolio. Many of our properties, we've had very little issue with rent collections, frankly. And I had seen a question pop up that I'll kind of address as part of the rent collection piece, which someone had asked if we primarily rent to Section 8. So no, we do accept Section 8 vouchers on a case-by-case basis for individual units and for individual people, but we do not primarily rent to Section 8. But that is, we are able to accept those vouchers, and we do accept those vouchers on a case-by-case basis for each of the properties.
Yeah, and well, there might be a stigma on Section 8. I own a lot of properties in California, and the best performing ones are usually the Section 8 tenants. They typically never really complain or never leave, and the government is one of the best on-time payers of rent.
Absolutely.
Parker, why should we invest in Kansas City? Why should us California folks and the other folks outside Kansas City invest in Kansas City?
Well, I think one of the things to kind of focus on here is that Kansas City has been really flourishing across the board. I'll tell you, in 2007, we started the renaissance of downtown Kansas City, and so downtown Kansas City was, frankly, 1990s was sort of a desolate place, and in the early 2000s started redeveloping the whole area. And when they started to do that, we brought the Sprint Center, Power and Light District, et cetera. Our population downtown has gone from 3,000 people to over 30,000 people. So what that's done is create an entire ecosystem where our downtown has been able to flourish, which has pushed more prosperity, frankly, to the outerlying areas as well. And so we've seen population growth across really the primary city of Kansas City, as well as the metro as a whole. We've seen crime reduction in the city reduce. Kansas City used to be kind of one of the top. It's still one of the top, but it's very isolated areas. And if anybody has questions about that, we can talk about that. But crime reduction has dropped. Employment diversity. We have a very robust economy with a number of different employers, from telecom to health IT to medical and biological research to all kinds of different things. So a very diverse employment base, and large manufacturing, and what we would at one point have called kind of blue collar jobs. We have a large manufacturing base here in Kansas City. In addition to that, though, we're also a technology hub. I mean, Kansas City has a substantial number of tech startups and tech related businesses like Cerner, Sprint, which have come out of Kansas City. And so we've also seen a large amount of kind of VC money come in to support new growing tech companies. We touched a little bit about the flourishing economy too. I mean, we've done a very good job continuing to grow, $2 billion worth of development since 2016, 4 years, $2 billion worth of development in this area alone. And that's about $1 billion of that has been kind of in the suburban parts of the market. And then demographically, people, you want to think about kind of what your average is. And so not only is our household income higher, but our household income higher than national averages, but our rent to income ratios mean that people have a lot more disposable income in Kansas City. Rents are still low, compared to rent to income ratios in other cities across the United States. And so there's really a gap there where I think A, rents will come up, and B, it's a very affordable place where people have a lot of excess income to spend.
Yeah, so Parker is very familiar with the history of Kansas City, and I look at the data. Job growth, population growth, crime decrease, those are the three factors that make fundamentals of the city grow. And there's a lot of the Midwest, a lot of this Rust Belt that don't have these factors. But there's a lot of great cities that do as well, like in Texas, Austin, Dallas. But we also love value. So Kansas City is an intersection of strong fundamentals and good value. And that's why we fundamentally believe we can buy in Kansas City and expand in Kansas City. There's a lot of runway, and we can provide our investors double-digit cash and cash returns. Can you talk a little bit about the independence market, Parker?
Absolutely. So the Independence market, so a bit of a background on Independence. So Independence is immediately east of Kansas City. Kansas City and Independence are the larger cities, obviously, in Jackson County. And Independence and Kansas City are both, it's a dual county seat county. So half of the county government is in Independence, in downtown Independence, and half of it is in Kansas City. And so you have kind of this large base there that I'll say kind of makes Independence flourish as well, and have kind of this stable base of government jobs, healthcare jobs, educational systems, et cetera. And what we have seen, I think, as downtown Kansas City has grown pretty rapidly, is there's been a push towards some affordability, which is why 2016, 17, 18, 19, and 2020, you've seen substantial rent increases across Independence without large numbers of new buildings being developed to show that rent growth. And so this is rent growth happening in existing properties as people are pushing into Independence from downtown. And additionally, as they've been doing this, and you can see that demand here in the historical occupancy rate of 95% plus, that's average across Independence, including bad properties, good properties, et cetera. And so having a 95% plus occupancy in Independence is a wonderful metric to be able to see, and we are typically underwriting to lower than that occupancy rate.
Yeah, and so we're underwriting to both lower to the occupancy and lower to the historic 5-year rent growth. So we fundamentally believe that these trends will continue to exist, but if they don't, we will still hit our numbers, and that's what we want to make sure we do. And so part of that is understanding where our safety lies. And I love the concept of DSCR, debt service coverage ratio. So when you get a 1, you're basically having enough net operating income to cover your debt. Remember, when you own real estate, one of the worst things you can have happen is when you can't pay your mortgage. And that's when you start losing money. For us, we're forecasting a vacancy of a little bit over 7%, which is above average historically. And that's going to give us an average DCR well above 2. If things go worse, we still can cash flow. If things are going in downturn, 20% vacancy, which would be catastrophic, we still will have enough to pay debt by at least by 58% more, and still have invested cash flow. So this is why I love buying things with Parker and FW. We love buying cash flowing assets because we have a strong fundamental buffer to have high DSCRs and provide our investors that safety when things go bad, and we can still pay the debt. So we have some of the floor plans here. One thing that when we visited the place is we saw that all the apartments were actually priced similarly across, for at least for Independence, across all the floors. Parker, would you want to increase the rents on the higher level floors?
Absolutely. So your first and second floor and your top 3 floors in a tower like that are going to have higher rents. But the previous management group, has kept the building very full and is getting, good rental revenues, obviously. But where we see that they have lacked in their management is they haven't kind of bifurcated that and pushed rents higher with the highest views, as well as higher for the easiest access would be the first floor.
Yeah. And can you talk about a little bit about the recent improvements and the upgraded chillers and windows in Independence Towers?
Absolutely. So the vast majority of all the windows across Independence Towers have been replaced recently, which is great for a number of different reasons, obviously. Additionally, there's some few things that they have done already to the HVAC systems, like replacing pumps, replacing the chiller, a number of things that are both going to increase operational efficiencies as well as reduce our risk of any unknown CapEx. The other thing as well is that the roof is in very good shape, the TPO roof, and it is all in very good shape. And so when we like to go look at a building, we like to look at the major mechanical systems, because those are the things that if they go wrong can be the most detrimental. And for the most part, all of those things are going to be fairly new in this property, meaning we won't have large CapEx expenditures in the foreseeable future.
And what kind of value add you think you would be doing for Stoneybrook?
So Stoneybrook, there are a few things that we think we can do to bring it to life. A little bit of exterior paint. There's a few little CapEx items that we see as needing necessary day one, which are some tuck pointing and some different items to the exterior. And then what we're going to do is continue to push through in the actual units. The seller has converted about 40% of the units to more of a premium unit type with LVT flooring and updated cabinets, painted walls, et cetera, and really kind of brought them in to the 21st century. So as units roll, we'll continue to implement some of those items in the new units that we push. As we're pushing rents when leases roll, we will continue to do those improvements.
Yeah, I think it's a really great combination of stable cash flow and value add, providing that quick value and refi at year 5, and then continue to cash flow and hold. Really a great coupon clipper at this point. So I wanted to just reintroduce the team: Parker, Logan, and Corey. Logan could not join us, but I'm sure he'll send you guys a video for those who are coming from the FTW side of investors. And Parker and Logan and Corey have several other properties in Independence and Kansas City. And Tozy Capital is partnering with them on the majority of them. So very excited to continue to extend that relationship. And so I know some of you guys know Kay as well, and Brett's on hosting with us. So they're members of Tozy, and we couldn't have done this without them. It takes a team to build this out. With that, I would like to kick it off to Brett, back to Brett to ask any additional Q&A.
Great, thank you. So we do have a few. I think you answered many of them as you were moments after questions were asked. So you were playing the magician, as one person said. But I'll just kind of talk through this a little bit. So is cash flow distributed to investors monthly, quarterly, or annually? I answered in the chat quarterly, but I'll let you correct me, Yang.
So Parker, typically we do everything quarterly. And why is that, by the way?
So these distributions would be quarterly. And the main reason that we do quarterly, a lot of people do like the monthly cash distribution check. But across a quarter, we have an ability to smooth out cash flows as different seasons provide different move outs and move ins, and all of those things are happening. And so to smooth that out over a quarter is a lot easier for us to manage the cash flow and ends up with a better result for everybody. It's also an easier task for management, right? When management has to do the distribution checks, it takes a little bit of time away from the day-to-day management pieces. So we like them to keep doing what they're doing, which is making the property improve in value and stay producing high cash flow. So there's a few reasons why we like to do quarterly cash flow distributions.
And Parker, I have another one for you. I know you're very passionate about Restart, the program we're in. There were several questions in the chat about Section 8 tenants and the strategy on this investment with Section 8, and why we should invest in this if you're not investing or if you're not renting with Section 8.
It's an interesting question. Why invest if you're not renting Section 8? So Section 8 would be a we will have Section 8 tenants in each of the properties. We have very good relationships with the housing authority, with organizations like Restart, which does homeless housing, and they are working with a number of organizations to get people employment and then help house them as well. And so we will continue to work with those groups. And frankly, as units become available, we will have conversation with the housing authority and other agencies in Kansas City like Restart, that those units are becoming available. And to the extent that there is additional supply of vouchers, we would love to take those tenants and those residents for the buildings. So I think it's, a part of it is that we have the ability to go to organizations like Restart and place those residents into our buildings. We also have the ability to go to them ahead of time. If we were to know that a large number of units may become vacant, or we decided to do a larger value add, which we don't intend to do. But for different projects like that, we have the ability to go to Restart and say, hey, we'll have 10, 15, 20 units available for you in 60 days. That gives them lead time to go put the pieces together on their end, and they can lease large blocks from us. So I guess to answer that question, we will be using both Section 8 and what we call market rate tenants. But both provide there's kind of income diversity there and whatever else. But what we don't ever want to do is rely solely on one strategy when it comes to residents. And so we see the ability to market rate tenants, as well as the ability to market to voucher tenants as kind of a mutually beneficial marketing effort.
Speaking of that one strategy, one thing I love about this property, these properties, is if you are selling them separately and buying them separately, you actually get a lower price. And it's kind of counterintuitive that if you buy them together or you sell them together, you can actually compress the cap rates because you're opening up to essentially a bigger audience. Parker, can you talk a little bit about why that usually happens?
One of the largest reasons for that is typical cost of capital for larger buyers. So larger buyers typically have lower costs of capital because they have large amounts of capital to place. And so combining these two properties, pushing the value as we're going to, and then taking it to market at those higher values is actually going to yield a lower cap rate overall, because we've entered into a whole new audience with a lower cost of capital.
Yeah, and one of the things I love about our strategy with FW is we play in the middle ground. We don't really typically go into the 50 and above institutional grade cap assets because it's, to be honest, just the returns aren't there. The cap rates are compressed. We're competing with REITs and big institutions. And, obviously the really small ones, they're competing with a lot of mom and pop, and it's a little bit more public money. So in the middle ground of the essentially Stoneybrook and Independence Towers, Stoneybrook Towers is where we find a sweet spot of high yield returns.
Okay, just being mindful of time, we've got a couple that I think we can answer quickly. How many elevators in Stoneybrook? The Stoneybrook Towers. I believe Independence Towers has 2. Is that correct?
That's correct. Two elevators in Independence Towers, and Stoneybrook does not have any elevators.
A few questions on, can we do 1031, IRA, solo 401k?
So IRAs and 401ks, yes. For 1031, we are not structuring this such that it would be immediately. If someone has a need for that, we can certainly talk about that offline. It takes some doing on our end. But certainly for other retirement accounts, that is something that we can accept.
I see a question about premature withdrawal. So typically the pro and con of real estate is that it's a illiquid asset, and there's a lot of pros to that. You don't have to sell when there's market volatility, and you don't have to. But the illiquidity means you can't really sell it when you want at any given time. But the good thing about the way that we accept investors, essentially you buy into shares of fractional ownership of an investment, and you have a pool of other investors. Just imagine it's like a pre-IPO stock. If you come to us and say, you invested $100,000, 3 years in, you've been collecting $12,000 a month every year, and you want to sell sell the shares back to us for 120,000. I would probably say that's a great deal. I'll buy it because we're 7 years closer to exit. We won't probably do an appraisal of your shares, so essentially be a secondary transaction. But yes, so that's what we've seen for in terms of liquidity. This is usually very rare, but it does happen sometimes.
Great. Can you, and you may want to go to the cash flow. Can you talk about a reasonable expectation on each quarter's distribution amount for 200K investment? Will it change over time?
So the 200K investment, what we would typically see is basically the 9% quarterly. So what is that? 3%? 3%. Right, that's right. Am I doing the math right? Yes, I'm doing 3% a quarter. No, that's not right.
2.25%.
2.25%. Yeah, I knew I was doing it wrong. 2.25% for the first quarter, and we would target the pref rate, and then we'll catch up to the full year, which we expect to be above right around 12%. So these cash flow is for 100,000. There will be upside for those who invest 200 and above. Although we can provide both those cash flow for you guys if you guys ask, and we can also provide the pro forma. So we're here at FW and Tozy, we're very transparent. So we want to make sure you guys can feel very comfortable with this investment, understand all the assumptions we made, and dig into it as you like. And we'll be happy to answer those questions on a call as well.
What is the timeline for this offering when you plan to raise or close?
Parker, you gonna take that?
Yeah, absolutely. Sorry, my computer froze here for a second. We are looking to wrap up the offering here in the next couple of weeks with investments being wired in by middle of December, and then we'll be closing by December 31.
And then these are probably some perma questions here. Parker, can you talk to things like concessions over the last the T3, T6, T12, and also turnover?
Yeah, so happy to dive into some of these questions kind of in more detail if someone has particularly detailed questions around these items. We'll make things like pro formas and financials available to those who request them. So over the last frankly, on the T12s for both of these properties, our year one projections are based on those T12s. And so we are seeing kind of the same thing that we're projecting out as what we've already seen. Typically, we'd like to go in there and even achieve more than that, but that's kind of how we've underwritten this today. Turnover has been pretty consistent across the portfolio with what we would normally expect. So typically in a market rate property, you typically see about 50% of your units turn on an annual basis. Affordable properties have typically a 25% per year turnover rate. And so we've seen kind of normal turnover rates in between those two numbers.
Sorry, Brett. One of the common questions I've seen, and somebody, Alexis, did ask about this on the low review ratings for these buildings. Parker, how do you commonly address this? Obviously, this is certain economic and demographic trends here. We're not charging $1,500 a month rents, but we also want to make sure that our tenants like where they live and feel comfortable with it. Who can you address the property management and what we're going to do when we take over?
Yeah, absolutely. So one of the things is we can do for any kind of previous expectations that there were is one of the best things you can do is obviously bring in new management and manage better. In this case, we'll be bringing in Atlas Property Management. It's a group that we do a lot of business with, manages a number of different assets for us, and they do an excellent job. We'll have full-time staff on staff. I think that increasing the professionalism of the management will be important for anybody, regardless of kind of the rental range. And so we'll see an increased, professionalism in that management. We'll see the ability to address concerns early on. Principally, we manage better than a lot of the people who are selling to us, and that's what we would intend to do in this case.
One of the questions I see is how close have you been to previous projections for past projects that you fully turned? Parker, how are your other projects doing?
Yeah, absolutely. So we are currently kind of in the early process of refinancing a few assets that we are 1 year and 2 years into owning here recently in this corridor that have performed very well. One of our properties has seen a 10% year-over-year rental increase since we purchased it earlier this year, actually. Another property that we purchased last year has increased in value by about $1 million more than we had sort of anticipated. So we're seeing great success with kind of the properties that we're buying throughout this area, both in terms of rental rate growth, in terms of property appreciation and cap rate compression. So we've seen very good trends, and that's why we're actually looking to refinance, do some cash out refinances early on some of these properties.
And I know one of your favorite things is to have tax advantaged investments. So this is a question for you. Will these be distributions of, return of capital or return on capital? And then can you talk about the 5-year refi benefits?
Yeah, so the refi benefits, so the cash flow would be passive income cash flow, not return on capital. Your capital will be returned on the refi and year 10. And on refi, it's actually would be a tax-free distribution as well. So that's one of the benefits, but refinances. And Parker, feel free to correct me if I'm wrong. What was the other question, Brett?
Oh, it was so just return of capital or return on capital, and you answered that, and then also the benefit of the refi from a tax perspective.
And from I see another question on how much is FCW and TOSI investing. So we typically like to invest at least 5 to 10% of the investment, and that's what we've done in the last few deals as well. While we don't have a number precisely in mind right now, I would buy this property myself if I could. That's one of the things that I try to do in all my investments. All of investments, we look to buy it because we want to buy it. We invest with you. And so for Independence 3, the last property we did, the sponsor team invested almost, I think it was actually 10% of the sponsor of the equity. And I would expect that we would want to make sure we have room for investors. We want to make sure, we want to make sure that the investors can invest, but that we will be having a significant skin in the game as well.
I like this last one, or this latest one. Eng and Parker, what's the biggest risk of this offering?
Parker, you gonna take it?
Yeah. It's always such an interesting question. I think every time we have an offering, that's a question that gets asked. And my immediate reaction is that a meteor strikes down and hits the building, right? I don't like to think, what the biggest risk is, but I think what the question really is what's the worst, most likely risk that could happen? And a couple of things that we just see generally across, investing period right now is one of the things we look at is, what happens if interest rates, go through the ceiling, right? If interest rates go up exponentially, what does that do to valuations? What does that do to pricing, et cetera? While cap rates traditionally have, held to some spread over the interest rate, that hasn't always been the case. And in high interest rate environments, it's usually not the case. And one of the reasons for that too is that in a high interest rate environment, if that was to be an environment that we walked into, you're going to see rental rate growth increase as well. And so even if you see some cap rate expansion, you're going to see rent growth expansion, sort of in theory, and in practice, we've seen that too. And so I think that, interest rate risk is always something that we look for. That's partly why we like to have the long-term debt locked in at a low interest rate. It reduces a lot of that refinance risk. In Stoneybrook, we'll have the opportunity to refinance within a number of different years over the next 5 years, and we will look to do that when it makes the most economic and financial sense. And so I think having those two strategies in play is important. We could also do a later refi on both assets since they are adjoining. We have some opportunities that open up on the financing side there.
What are the general differences in the tenant base between the two properties?
I wouldn't particularly say that there is a general tenant base, difference. I would say, across demographic between both of them, I think you'd see similar demographic trends, similar income trends, et cetera. So I wouldn't say that there's a substantially different, demographic of renter for each of these buildings, which is actually why I think they also work very well as a cohesive unit.
Okay, and there's a few questions about why they're selling. So maybe I'll tailor it to why are they selling, and why is it to us?
Well, so I can answer the why it's us question probably easiest. I think one of the things that has been really great for us this year, and I kind of feel bad saying that because it's been a rough year on a lot of people, but for us in Kansas City, we've had the ability to go and frankly get pricing on assets that we would often get overpriced on by kind of more quasi-institutional coastal money. With the travel restrictions that have been in place and the COVID scare that has happened across the country, that's frankly affected the coast a whole lot more than it has here. Although recently our numbers have risen, but we haven't seen a whole lot of change to really to how we are conducting business. We've been able to get into properties and get under contract on properties because we're able to get there and tour them, and people from New York and California haven't always been able to get here and do that. So I think that's part of it. The other part of it too is relationships. These are people that we know. My grandfather's friend was the original developer of this building, right? And so these are long-term relationships that we have in this community. And when people want to bring an asset to market, they come and talk to us about that. So I think that's part of it. The other thing too is that they bought this asset a number of years ago. They had done improvements to the asset to push rents up themselves, and they're going to make a profit on their exit. And so they had the time to do it. It was a good time to do it, and they decided to take it to market to sell. And so we were there at the right time to be a buyer.
Yeah, and when we sell it in 10 years, we will make sure that it's a good asset for the next buyer to sell. And we will have made a significant amount of money, and they will too. It's a life cycle of real estate, and that's a great life cycle. Everyone makes, it was a win-win, everyone gets depreciation as well. And it's funny, for Independence Towers, I remember we were circling this for quite a while. It came back to us after a few other folks had much higher bids because of the relationship that Logan and Parker had. And it's always surprising. I make offers a lot on a lot of buildings, a lot of assets in Kansas City, along with FW, and we're overbid quite often. It's a hot market still. A lot of people have a lot of money. Assets are inflated and going up. The Fed actions on liquidity have made it so that financing is cheaper than ever. So people can afford more. And we're just never I don't think we're ever gonna be at a level where we will overpay for something. So we were happy that we could get it to the level that ultimately we could underwrite it to, that we're comfortable at.
Great. So we're a little over time, but we'll take one more question. And then if there are other questions, we'll show email addresses in a second on how you can ask more questions. But can you please repeat the deal basics? And I can pull this up, Parker, if you need, but equity amount, debt amount, and purchase price.
So if you, Parker, do you have it, or do you want me to say it?
Yeah, sorry, I was on mute. Yeah, so we are, our total price here that we are, sorry, I'm trying to pull up the
it's 9.2 million purchase price total combined.
Yep, absolutely. We're going to be on an average LTC of 72.64%. So that's 7.3 million in loan and basically 2.8 million of debt. I'm sorry, 7.3 million loan, 2.8 million of equity.
Yeah, and the equity amount is full is 2.7 million. So it's a bit of a smaller raise for sure. And we do expect this to fill up pretty fast, considering that it's one of the more ideal ways to get the tax benefits and have significantly high cash flow with a blended strategy, right? So not just cash flow, but with a little bit of pop at year 5 to supercharge a little bit of IRR. I think this can be a great investment to close out the year.
Great. And Eng, you just want to send us off on that last slide? See if we can see your email.
Yeah, so sorry we couldn't get to everyone's questions. We do appreciate them, and we'll try to reach out to everybody who has the questions. Feel free to connect with us at these email addresses, our website, and we will be sending everybody a form to express your interest, and then we'll have a lot more information in our investor portals. So this is just a presentation slide, but we'll have a lot more of the details that potentially you guys would like to see. And then feel free to just schedule time with us, and we'll make time for you guys. 15-minute, 30 minutes call. Happy to answer any questions, and hopefully you guys invest. And hopefully this is the first of many, or the second, or third, or fourth of several.
Perfect.
All right, guys.
Thank you, everyone. Thank you, Eng and Parker. Hope everyone, you have a great night. Please get in touch if you have any questions. We're looking forward to talking to you.
Take care, guys. Have a good night.